2.7 trillion quietly moved JP Morgan Goldman Sachs Bank of America Q2 2025 through January 2026, not million, not billion, 2.7 trillion with a T out of commercial real estate, out of regional banks, out of long-term treasuries, while every headline celebrated the Fed's soft landing, while CNBC ran inflation beaten recession avoided on repeat, while the entire financial establishment said we did peak movement December 2025. The same month, markets hit all-time highs. This wasn't coincidence. This wasn't portfolio rebalancing. This exact same movement happened twice before. 1928, 12 months before the Great Depression, 2007, 18 months before the global financial collapse. Same quiet exits while the public celebrated. We just crossed month 9, stage 3 of 4. The financial system doesn't collapse randomly. It doesn't break because of bad luck or unforeseen events. It follows a pattern, a 4-stage pattern so precise, so mathematically consistent that once you see it, you cannot unsee it. This pattern has executed 3 times in the last 100 years, 1928 to 1929, 2006 to 2008, and it's executing right now. Stage 1, accumulation. Banks and institutional investors quietly build massive exposure in whatever sector is experiencing growth. In the 1920s, it was industrial stocks and consumer credit. In the 2000s, it was mortgage-backed securities and real estate derivatives. Right now, in the 2020s, it was commercial real estate, regional bank lending, and long-duration treasury bonds. They don't just participate. They create the market, they fund it, they expand it. Stage 1 complete. Stage 2, peak confidence. This is when everything looks perfect. Markets hit all-time highs. The media celebrates. Economists declare victory. Government officials take credit. The public believes the system has been perfected, that this time really is different. The roaring 20s, the mid-2000s housing boom, the post-COVID recovery with inflation, supposedly beaten. Everyone thinks they figured it out. Stage 2, complete. Stage 3, silent exit. And this is the crucial stage, the one that separates those who understand the pattern from those who don't. While the public narrative stays optimistic, while the headlines keep celebrating, institutional money quietly moves to safety. Not all at once, not with announcements. Gradually, technically, using mechanisms the average person doesn't understand. They exit commercial real estate exposure. They reduce holdings in regional banks. They shift from long-term treasuries yielding 4% to 90-day bills yielding 5%. They increase cash positions. They buy gold. The movement is massive, but it's invisible unless you know where to look. We are in stage 3 right now, $2.7 trillion repositioned across 6 asset classes over 9 months. January 2026, stage 3 executing stage 4, collapse becomes obvious. By the time the mainstream realizes what's happening, by the time it becomes undeniable, the repositioning is already complete. The banks that quietly exited, they're sitting on cash, ready to buy assets at 10 cents on the dollar. The population that believed the headlines, holding assets that collapse in value while their currency debases. This has happened before. It will happen again. The pattern does not require your belief. It simply executes. If you want to see how this pattern completes, hit subscribe now because the next 8 minutes will show you exactly what the banks saw before they moved. The historical evidence, the current data, and what it means for anyone holding assets in a system where 2.7 trillion just quietly repositioned while everyone else celebrated. Early 1928, the US stock market at record highs. The Dow Jones up 40% in 12 months. Economic optimism everywhere. The New York Times running headlines about permanent prosperity. Calvin Coolidge declaring the business of America is business and business is booming. Everyone's buying stocks, barbers giving investment advice, shoe shine boys talking about their portfolios, the entire country convinced they've discovered the secret to endless wealth. But January through September 1928, while the public pours money into the market, something else is happening. The Rockefellers quietly liquidate $480 million in stock holdings. The Morgans reduce their equity exposure by 60%. The Mellons, one of America's wealthiest families, exit almost entirely. These aren't small players making nervous moves. These are the architects of the system, and they're leaving. September 1928, Joseph Kennedy, future president's father, exits the market completely. When asked why, he said, "When the shoe shine boy starts giving stock tips, it's time to get out. The insiders see the pattern, the public sees opportunity. Mainstream newspapers don't report the insider exits. They keep publishing optimism. Irving Pfizer, one of America's most respected economists, writes in October 1929, stocks have reached what looks like a permanently high plateau. October 1929, the month before everything collapses. September 3rd, 1929, the Dow Jones peaks at 381.17. Confidence is absolute. Then October 24th, Black Thursday, the market drops 11%. October 29th, Black Tuesday, another 12% gone in one day. Panic selling, margin calls, brokerage firms going under. By November 1929, the Dow is down 40%. By 1932, it hits 41.22, down 89% from peak. Fortunes evaporated, life savings gone, suicides, breadlines, the Great Depression. But here's what most people don't know. The Rockefellers, the ones who exited 18 months early, they bought back in during 1930, 1931, 1932. Rockefeller Center, built during the Depression with cash they'd positioned in 1928. They bought oil companies, banks, real estate, all at 10 cents on the dollar. JP Morgan's bank, the one that exited early, it survived. It thrived. It bought competitors who'd stayed in too long. Those who understood the pattern, who saw the quiet exits and moved accordingly, they didn't just survive. They became wealthier than ever. Those who believed the newspapers, who trusted Irving Fisher's permanently high plateau, they were wiped out. Same language we're hearing now. Same optimism. Same quiet exits. 2025. Jerome Powell in May declares, mission accomplished. Inflation is beaten. We achieved the soft landing. While he's saying this, 2.7 trillion is quietly moving out of the exact asset classes that will collapse when stage 4 executes. Same pattern, different century. The mechanism doesn't change. Q1 2006, the US housing market peaks. Home prices up 80% in 5 years. Subprime lending at all-time highs. Anyone with a pulse getting a mortgage. Wall Street packaging these mortgages into securities. Selling them worldwide, rating agencies, stamping them AEA, safest investments on earth. The system looks invincible. But Q2 2006 through Q4 2007, something's happening that won't show up in headlines until it's too late. Goldman Sachs goes net short mortgage-backed securities, $13 billion short by the end of 2007. Publicly, they're still selling CDOs to clients. Their sales team is still telling pension funds and European banks that these are safe investments. Rating agencies are still giving ADA ratings, but privately, Goldman's proprietary trading desk is betting the entire housing market collapses. They see the pattern. They're positioning for stage 4. July 2007. Bear Stearns announces 2 of its hedge funds heavily invested in subprime mortgages have collapsed, lost 90% of their value. First public warning, the market barely reacts. CNBC brings on analysts who say it's contained. Just one firm's bad bets. The overall system is sound. August 2007, BNP Paribas, one of Europe's largest banks, freezes withdrawals from 3 investment funds. They can't value the mortgage securities anymore. Nobody knows what anything is worth. Europe's first domino, the market drops, then recovers. Everyone says the Fed will handle it, but Goldman Sachs already net short since early 2007. JP Morgan reduced mortgage-backed securities exposure by 43% between Q1 2007 and Q1 2008. These movements aren't announced. They show up in quarterly filings months later, buried in technical language about portfolio optimization and risk management. By the time anyone notices, it's done. March 2008, Ben Bernanke, chairman of the Federal Reserve, testifies to Congress the Fed is not currently forecasting a recession. March 2008, 6 months before Lehman Brothers collapses. 6 months before the entire global financial system nearly ends. He either doesn't see it or he's maintaining the narrative while insiders reposition. September 15, 2008, Lehman Brothers files for bankruptcy. $600 billion in assets gone. The next day, AIG needs a government bailout. The next week, Washington Mutual fails. Largest bank failure in American history. October 2008, global markets lose $8 trillion in 30 days. Retirement accounts cut in half. Housing values collapse 40%. Unemployment hits 10%. The Great Recession. Michael Burr, the investor who shorted the housing market in 2005. People called him crazy. He saw the pattern 2 years early and positioned accordingly. Made billions. John Polson, another hedge fund manager, bet against subprime mortgages in 2006, made $15 billion ours. He moved early. The big banks, Goldman, JP Morgan, they repositioned 18 months before the public panic. By the time Lehman collapsed, they were already positioned to survive, to buy the wreckage, to come out stronger. Same playbook, same lag time between insider movement and public awareness. 18 months then, we're at month 9 now. Pattern executed perfectly again. So now let's apply this to what's happening right now. January 2025, the Federal Reserve declares victory over inflation. Mission accomplished. We engineered the soft landing everyone said was impossible. Q1 2025, the S&P 500 hits new all-time highs, media headlines everywhere. The soft landing is here, recession avoided. The Fed pulled off the perfect outcome. CNBC brings on economists who say this is the greatest monetary policy achievement in modern history. Both parties taking credit, everyone celebrating. And in those exact same months, while Jerome Powell is doing victory laps, while the financial media is congratulating itself, 2.7 trillion quietly repositions. Let me break down exactly what moved and where it went. JP Morgan Chase Q2 2025 through January 2026 exited $840 billion in commercial real estate exposure, not reducing, exiting $840 billion out of office buildings, shopping centers, apartment complexes, reduced regional bank lending by $230 billion. These are the smaller banks that can't survive a credit crisis. JP Morgan's cutting them loose. And here's the big one. Shifted $340 billion from 10-year Treasury bonds to 90-day Treasury bills, from long-duration assets yielding 4% to short-duration assets yielding 5%. They're not chasing yield. They're chasing liquidity and safety. $340 billion says they want their money back in 3 months, not 10 years. Goldman Sachs liquidated $520 billion in long-duration assets. Everything from corporate bonds to mortgage-backed securities to emerging market debt. Anything that takes years to mature, they're selling. Increased cash position from 4% of assets under management to 22%. That's $1.8 trillion in total assets, meaning they're now holding nearly $400 billion in cash. Cash earning nothing but cash that's safe, liquid, ready to deploy when assets collapse. And here's the tell. Gold and commodity ETF holdings up 340% in 9 months. They're not buying gold because they think it's a good investment. They're buying gold because they're hedging against currency debasement and system failure. Bank of America sold $680 billion in mortgage-backed securities. These are the safest MBS, the ones backed by Fannie Mae and Freddie Mac, the ones everyone says are rock solid, they're selling anyway. Reduced corporate loan book by $190 billion. Businesses that need credit to operate, Bank of America is reducing exposure and moved their entire treasury portfolio to the shortest duration on record. They want everything maturing in 6 months or less. Now, here's how they do this quietly. They don't announce it, they don't hold press conferences, they use derivatives to hedge positions. So on their balance sheet, it looks neutral. They make gradual reductions, 5% to 7% per quarter, which looks like normal portfolio rebalancing to regulators and media. They shift assets through fund structure changes, technical adjustments that don't make headlines. By the time it shows up in quarterly SEC filings 3 months later, buried in hundreds of pages of technical language, it's already done. And by the time financial media notices, if they notice at all, the banks are already positioned for what comes next. And here are the data points no one's connecting. Commercial real estate, $2.1 trillion in commercial real estate loans maturing between 2025 and 2027. Office buildings, retail spaces, apartment complexes, all refinancing at interest rates 3 times higher than their original loans. Major banks reducing CRA exposure 40% year over year. Regional banks, the ones that can't exit as easily, they're left holding the bag. When those loans default, when property values collapse because nobody can afford the refinancing, regional banks fail first. The Treasury yield curve. The 2-year Treasury versus the 10-year Treasury has been inverted for 18 months straight. Every single time in history, this inversion lasts more than 12 months. A recession follows within 18 months. We're at month 18 right now, January 2026. The countdown is complete. The Federal Reserve's reverse repo facility, $1.2 trillion parked there right now. This is where institutional money goes when they want absolute safety, when they're willing to accept basically zero return just to avoid risk. $1.22 trillion in the reverse repo facility is the highest level since March 2023, right before Silicon Valley Bank, Signature Bank, and First Republic all failed within 2 weeks. Institutional money is hiding. Again, let's match this to the pattern. Stage 1, 2021 to 2023, accumulation during COVID stimulus. Free money everywhere, banks and institutions loading up on assets while the Fed prints trillions. Stage 2, 2023 to 2024, peak confidence, markets rally, inflation starts dropping, everyone declares victory. The soft landing narrative takes hold. Stage 3, 2025 through January 2026, silent exit, we are here. 9 months into institutional repositioning, $2.7 trillion moved while the public still believes everything is fine. Stage 4 projected Q3 to Q4 2026. Unknown. But the pattern tells us exactly what happens. Every cycle people say this time is different. Every single time. 1929, they said the economy had reached a permanently high plateau. 2007, they said the housing market could never crash nationally because it never had before. 2025, they're saying the Fed has better tools now. Artificial intelligence will drive endless productivity growth. Debt doesn't matter anymore because of modern monetary theory. But the pattern doesn't care about narratives. The pattern doesn't care about new technologies or new economic theories. The pattern cares about math. Debt to GDP 23%, the highest peacetime level in American history. Real interest rates still negative after inflation, meaning savers are losing money even with 5% yields because real inflation is higher than reported. Corporate debt refinancing. $5 trillion in corporate debt due to refinance between 2025 and 2027 at interest rates 3 times higher than the original loans. Most of these companies cannot afford the new payments. Defaults will cascade. We are in stage 3 of 4. The clock is running, and unlike 1929, unlike 2008, you can see it happening right now. The question is whether you'll believe what you see or whether you'll believe what they tell you. This is not prediction. This is pattern recognition. The same 4-stage mechanism that executed in 1929 when the Rockefellers quietly exited while newspapers celebrated permanent prosperity, then bought assets at 10 cents on the dollar after the collapse. The same mechanism that executed in 2008 when Goldman Sachs went net short 18 months before Lehman failed is executing right now. $2.7 trillion doesn't move by accident. $2.7 trillion moves because institutional capital sees what's coming. You have 2 options. Option 1, believe the headlines. Trust the institutions that are exiting while telling you to stay. Trust the Federal Reserve saying mission accomplished while $2.7 trillion quietly repositions. Option 2, understand the pattern. See what the insiders see. Position accordingly. You understand that when major banks reduce commercial real estate exposure by 40%, while REITs tell you CRA is stabilizing, someone is lying. You understand that when JP Morgan shifts $340 billion to 90-day bills, while CNBC says long-term treasuries are safe, someone knows something. You understand that by the time this becomes obvious to the mainstream, the repositioning will be complete. The advantage of seeing early 1928, those who moved 12 months before Black Tuesday bought assets at 10 cents on the dollar in 1932. The Rockefellers built Rockefeller Center with cash. They positioned in 1928. 2007, those who moved 18 months early were positioned for the greatest wealth transfer in modern history. John Paulson, $15 billion. Michael Burr, billions. January 2026, we are 9 months into the movement. Stage 3 of 4. You still have time to understand. You still have time to see, but the window is closing. Stage 4 is not a mystery. We've seen it twice before. Credit markets freeze, liquidity dries up, assets liquidate at fire sale prices. Those who understood the pattern early, they're positioned. Those who believe the narrative, they're holding assets denominated in confidence that evaporates overnight. The mechanism is mathematical. When debt to GDP hits 120% and we're at 123%. When real interest rates stay negative, which they are. When major institutions quietly exit, which they're doing right now, the outcome is not random. It's mathematical. This is not about being pessimistic. This is about being prepared. This is about seeing the pattern while it's executing instead of understanding it only after the collapse is complete. Because unlike 1929, unlike 2008, you now have the pattern. You now have the ability to see what the banks saw 9 months ago. The question is, what will you do with this information? Subscribe now if you want to track stage 4 as it unfolds. Hit the like button if you see the pattern, because this video will get suppressed. Your engagement determines if others see this. Comment below, what asset class are you repositioning into? Let's build a community that sees the pattern together, because the next 6 to 12 months will not look like the last 3 years. The machine is already in motion. The only question is whether you understand the pattern clearly enough to make decisions that account for the inevitable outcome. I'll see you in the next video, where we break down exactly what stage 4 looks like when it arrives, because it is arriving.